Hi everyone, welcome to the webinar today on the Pinnacle Heights Apartments. We're going to run you through a little bit of what we like about this deal and the firm. If you have any questions, you can go ahead and just post those questions in the chat now. Be happy to answer those at the end, as well as the questions that you've submitted in advance. So many of you know us already, but I'm Andrew Reichert. I'm the founder and CEO of Burgo Capital. We've had this company in existence for over a decade now. I've been investing for about 17 years. Prior to that was in banking, so really cut my teeth understanding the financial side of our business, underwriting, loans, things like that. And also got some experience doing development and leasing and some of the nuts and bolts of real estate operations.
And my name is Josh Fisher. I'm one of the principals here and I oversee all of our acquisitions efforts. I've been in real estate investing and private equity for over a decade and have about $350 million worth of deal experience.
So just to run you through the agenda for today, We'll do an overview of us as the sponsor. Many of you know us already, but we'll just do a brief overview of who we are as a firm. Pinnacle Heights, we'll talk about the deal, what we like about the deal and the profile. Then we'll actually talk about the market. Pinnacle Heights is in Morgantown, West Virginia. We'll talk about why we like Morgantown as well. We'll run through a few case studies from other projects that are like this one, where we've added value and operated them similar to this asset. And then we'll save some time at the end for the Q&A. Like I said, you can go ahead and post any questions that you have in the chat now. This is just a legal disclaimer. Basically, you have to be an accredited investor to invest into this property and this project. So hopefully you're an accredited investor, and otherwise there's lots of legal disclaimers that are in the offering memorandum that we'll be signing along with subscription agreements. So with that, let's go ahead and jump into the overview of us as a firm. So Burgo Capital boasts a over 10-year history. So the original creation, the name of Burgo, came from Go Realty, a company that I had created, and Birchmere, a local venture capital company. And we fused together to create Burgo Capital. Since then, we've launched 4 funds. We've acquired over $300 million of assets, and we've been operating with a team that we've built up of just about a little over 100 employees. And speaking of that team, one of the things that's unique about us is our team does all of the operations for our assets as well. So we have full in-house property management, leasing, maintenance, and we feel like that's a real differentiator for us. Helps us to control the process a little bit more rather than farming out the property management. We're hands-on operators and asset managers of the assets that we operate. We've acquired over $300 million, a little over $340 million of assets at this point, over 3,600 units, and we've generated over a 19% gross internal rate of return from all of the properties that we've operated. So with that, Josh is going to run you through the opportunity here.
Thanks, Andrew. So Pinnacle Heights Apartments deal overview. Just want to address on the front end, we're excited about this opportunity because this is an asset that we currently own and manage. So this was one of the first deals that we did in our second fund. It's been a great deal for us. We really have enjoyed owning and operating this property, and we are closing in on the end of our fund life for the vehicle that currently owns this asset. So we're at a place where it's time to harvest. However, we really enjoy owning and operating the asset, and we on the acquisitions team have done our homework, and we believe that there's actually an opportunity to implement even more value add strategies into this particular asset. So we're bringing it to you, our investors, for an opportunity to reinvest in this asset with new equity, a new business plan, new return metrics that we think are really strong. And we actually think the opportunity is significantly de-risked because we have such a strong history and such a strong knowledge base of the asset itself. So deal overview, we're looking at a $19.2 million purchase price for the asset. It's 174 units, again, in Morgantown, West Virginia, like Andrew mentioned. Really strong rental market and strong appetite for rental at this asset in particular that Andrew will be getting into when he discusses the market. And we're looking at an 18.1% projected IRR for the deal. So what's the value proposition? Again, it's really a de-risked investment. Whenever you're buying workforce housing in particular, you want to be careful with surprises. Nobody wants to buy an asset and they find out that it needs hundreds of thousands of dollars in upgrades because there are surprises. And that's something that we've de-risked here. We've owned the asset for a substantial period of time. We know it really well. And we've done a lot of upgrades already. We've done new decks and balconies. We've put in a new dog park. We've got newly paved roads and parking lots. And about 2/3 of the units have been upgraded already. A lot of things that could be surprises have already been taken care of. Also, an opportunity for forced rent growth. So lots of people are talking about rent growth with opportunities. We think it's really important that we know how we're going to drive that rent growth as opposed to just relying on generic market rent growth. So there's an opportunity to do some light value add work in the units and at the property and to increase rents to market through those upgrades. We're also assuming attractive debt and positive leverage on day one on this deal, which is a differentiator in today's capital markets. We are assuming a 4.58% interest rate. That would equate to 61% loan to value, and that's going to help boost the cash on cash return because, again, we're significantly under where interest rates are today. Again, property-specific experience de-risked by our familiarity with operating the asset. We have 6 years of experience as the owner-operator, and we know it really well, which allows us to underwrite with a really high degree of confidence. And then lastly, we would call this really a blue-chip asset, really solid historical occupancy. It's in a phenomenal location within the Morgantown submarket, and we have attractive assumable debt in place. So all in all, we're looking to hold the asset for 5 years. We're targeting over an 18% internal rate of return and a 2.07x target net equity multiple to our LPs over that 5 years. So some details about the property. Again, 174 units. This was built average of 2002. It was phased construction. Just over 155,000 square feet, 11 buildings, 4 acres. And again, just a really pleasant campus setting for the asset, and you can see the new decks that we've put on that look really nice in these photos. So the location itself, again, highly desirable location, just minutes from a healthcare hub. You've got West Virginia University and the hospital system associated with that university. There's a municipal airport, and just really major area employers are within close proximity to the asset, and that's been proved out through rental demand over the last 6 years. There's also just a lack of similar assets. There's not much quality Class B product, and that combined with the close proximity to the economic drivers makes it just a really stellar location. There's also been rent growth in the market. Asking rent is projected to continue growing at 4+% per year, so there is an opportunity for upside above and beyond the rent growth that we're planning to force through our value add strategy. Rents right now are below market based on where they could be with the completion of the unit upgrades. So we're currently at $816 and $870 for 1 and 2 bedroom units. Post reno, we're actually going to be at just over $900 and $985. And Andrew will talk about this, but in particular, average household income within 1 mile of the subject is over $100K, so really strong incomes to drive demand for the asset. So what's the unit upgrade program? Pretty capital light. We've already upgraded about 2/3 of the units with about 1/3 remaining. You can see biggest visual pop and biggest bang for the buck. You can see the before and after on the flooring, the before on the bottom right, and the after on the bottom left. We have a great luxury vinyl plank product that we put down and really improves the kind of wow factor of the unit as you walk in, and it's also less expensive to maintain. So what have we done already? Again, I've mentioned new paved roads and parking lots. The roads were in pretty rough shape when we acquired the asset 6 years ago. That's already been done. New decks and balconies throughout, new roofing and gutter repairs. We've done a lot of the HVAC. So just, again, a lot of the capital intensive work that can be kind of difficult to predict from a cost standpoint has already been done, de-risking the investment and the capital stack. We have an operating pro forma here. I won't get too in-depth. The basic punchline here is total income in year one of about $1.8 million. We're looking to drive that up to just over $2.25 million in year 5. And that's really what's going to drive the valuation at exit. Rent roll and market rents. Again, we're looking at driving about a 9% rent increase through renovating the balance of the units that haven't yet been renovated and doing some capital light exterior upgrades. So really conservative here, but that generates a nice return like we saw on the last slide. And again, our operations team has seen this and they feel very comfortable that we'll be able to achieve these rents after we finish completing the balance of the units. So opportunity summary, again, we've been through this, 174 units, we're acquiring it for $19.2 million with the recapitalization. Great in-place debt that we're going to be able to assume at below market rents, and we're looking to generate over a 2x multiple and an 18% IRR within a 5-year period. And with that, Andrew is going to give an overview of Morgantown and why we like this market in particular.
Yeah, thanks, Josh. Morgantown is an area that we've been really excited to be moving into and expanding into and operating in. Some of the reasons why, we really feel like Morgantown is undergirded by a very strong, stable economy. One of the things we talk about a lot here at Burgo is the meds and the eds. Mm-hmm. So we like to acquire in areas that are undergirded by strong medical areas and strong educational areas. And, West Virginia University is really a powerhouse down there in Morgantown, a huge economic driver for that area. It's also just the fastest growing city in West Virginia. So not only is it, home to the university and to the medical facilities there, but it's really growing. People are moving into that area, continuing to grow and also just very stable in general. And the other thing I would note is it's supply constrained. So one of the things about this area is there's just not enough apartments. There's just not enough of this kind of product. And that's why market rents have continued to increase. And that's why we believe that market rents will continue to go up. Some of the statistics are here at the bottom. You'll see that the median age is 24 years old, so it's definitely got a younger, kind of vibrant feel to it. That's great for the sort of post-college folks who are looking for this exact kind of a product. You'll see vacancy is still very low at 6%. So vacancy is low, unemployment is low. So that's been great. It's really, the economy has done well, and we believe it will continue to do well. Demographics. You'll see that, as Josh mentioned, there is average household income within a 1 mile radius is over $100,000. So when you look at the percentage of rent for the average rents at this particular property, is very, very affordable by the demographics that live in this particular area. So that's one of the things we really look for. We look for, hey, let's make sure that we're staying well below the average household income, and that's definitely the case with this particular property and this particular demographic. And just Morgantown rent growth in general, as you'll see, the last 5 years have been really good for multifamily rent growth in Morgantown, and we believe that trend is going to continue, kind of to remain strong. You'll see 2023 a little bit of kind of dipping and flattening out, but that's really just a function of the fact that folks are really kind of settling into some of the growth that has happened over the past 5 years. And as Josh mentioned, we're not really in the business of trying to estimate what is the market going to do from a market growth perspective. For us, we believe that we can force rent growth by doing some of the things Josh mentioned, swapping out the flooring and really the particular growth that we're talking about here is just 9%. So it's going from like 850 to 900. Across the properties, or maybe 950 at some of our 2 bedrooms. So that's how we think of rent growth at the property and how it relates to the market in general. So let's talk about a few case studies where we've done this before. This particular asset is actually one of those kind of case studies where we've done this before. But just to go through a few other examples, Sylvan Ridge Apartments, 120 units in Beaver Falls, Pennsylvania. Very, very similar product in terms of the folks that are renting the types of units. This was 120 units that we'd originally purchased for around $5.5 million. Just a few years later, we refinanced that asset for over $8 million, generating a 42% IRR to our investors. Really, the main driver here was rent growth. Again, just the rents had continued to grow as we go through and renovate units. And also just managing expenses a little bit better by bringing economies of scale. The nice thing about us is we operate 3,600 units. So when we buy property with 100 or even 170 units, it's a part of a larger portfolio, so we have more buying power. Similar example, Skytop Village Apartments. This was 89 units. We purchased for $3 million. We actually sold this one for $4.6 million. Just a few short years later, generated a 2x multiple and a 33% IRR. This is really a function of the cap rate changes in this area. Again, we never really bank on that, but when it happens, if we can acquire something at a cap rate that is a little bit higher, and then kind of have the cap rate come down as we look to exit, that's something that we can do, and often something that we can do just a function of the markets in which we're buying. They tend to have a little bit of those higher cap rates anyway, and we tend to sell to a little bit more institutional sellers, particularly when we're selling, because those tend to look for more professional property management, the kind of stuff that we do. And last but not least, this is 54 units, Parkside Apartments in Wilmerding, Pennsylvania. Again, this was one that we owned. We bought for $2.2 million. We owned for about 5 years. And really the story here is kind of buy low. We love to buy when we can at a very low cost basis. That's kind of the case across our entire portfolio. Is we're always buying below replacement cost. And so if you look in a lot of other markets, a lot of other operators in particular, they tend to be buying at, well over $150,000 a unit, things that are newer construction, Sunbelt, the kind of stuff that a lot of other folks are doing right now. We're always buying below replacement costs. So that's really something we feel like is a real differentiator for us. All right, so let's jump into the Q&A. I know a few of you have submitted questions in advance. We'll go ahead and talk through those now. But if you have additional questions, you can just go ahead and submit them in the chat. We'll try to get to them today. If we don't get to them today, we'll be happy to answer your questions at some point in the future. We'll be happy to send you an email. So with that, let's jump into our first question. So first question is just like kind of an overview of the opportunity. What is it that you like specifically about the property? Josh, do you want to talk about that one?
Yeah, happy to. I mean, like I said, we looked at this just like we were buying an asset that was out on the open market and evaluated it that way as the acquisitions team. And there are a number of things that we like about the opportunity and think that it's really a strong candidate for reacquisition. First, again, de-risked investment. Really can't emphasize this enough. The fact that we've had the asset for 6 years really removes the surprise factor from the equation. We're not going to acquire it, get into it, and then find out that we inherited a mess. We've been managing it for 6 years, and we know what we're getting. And we've done substantial upgrades already. Again, new decks and balconies, new dog park, newly paved roads, and just really clear opportunity to force rent growth, like I mentioned, through finishing the remaining unit upgrades and feeling very confident with what those upgrades will drive in terms of post-renovation rents. Assuming the attractive debt and positive leverage on day one going in, another really great factor in today's capital markets where the debt piece of the capital stack is a challenge and is often your interest rate's actually higher than your cap rate. So you have ground that you have to make up. It's not the case here. We're going in at just over 4.5% on the interest rate. And then, last thing I would say, blue chip asset, like I said, solid historical occupancy, fantastic location within a market that we really like, and an opportunity to force rent growth through a light value add program. So great question. This is a good one, and Andrew, I'll hand this over to you. So how did you come up with the purchase price given the related nature of the parties?
Yeah, it's a great question. So obviously we want to take this stuff seriously in terms of making sure that we're protecting the best interests of our investors. In this case, our investors on both sides of the transaction. So first thing we do is we have our asset management team engage a national broker. So in this case, they engaged JLL, and they basically come up with a valuation for the asset. So just as if we were going to sell the asset to an external party, we engage a broker and say, hey, what do you think we could get for this asset? So they basically came up with a valuation of $19.2 million, which is the purchase price that we're looking at here. So then we have two options. We can either list it externally for that price, or we can see if our in-house acquisitions team wants to acquire it and kind of take it for another 5-year round. So in this case, the acquisitions team, Josh and his team, looked at the asset and said, hey, $19 million, we believe that we can kind of continue to add value over the next 5 years. We believe that we can actually generate this around 18% IRR. And they said, we'd like to have a shot at acquiring it and continuing to operate it. So that's how we come up with the purchase price. We make sure that both the seller, has a sale price that works for them, and the buyer has a buy price that works for them. And that's, that price is determined from, again, a national brokerage, in this case, JLL.
Yeah, great question.
Yeah, good question. So next question here is, can you tell us about the cost of the capital improvements that we're doing? Do you want to hit that one?
Yeah, happy to. So like I mentioned, not a super capital intensive business plan. We're at about $500,000 total against the $19.2 million purchase price. And that breaks out to, of the 1/3 of the units remaining, it's about $3,700 a unit. Again, the primary driver there is the new luxury vinyl planking for the floor that creates the nicer visual appeal and the increased rents that we've seen at this property and through the rest of our portfolio. We have about $100K for exterior CapEx. So this is mainly some landscaping, some power washing of the decks, again, some capital light items that add to the visual appeal of the property. It's important that when prospective tenants are pulling up to an asset, that there's some visual appeal that makes them feel like, oh wow, this is somewhere that I would be proud to have friends and family over and call home. And then we have contingencies built into both of those numbers both of those numbers as well. Rather, we always want to make sure that we're adding a buffer. We always believe that we know what things are going to cost, but things can come in higher, so we always want to make sure that we've done math for that, and we have here. And again, I would just really drive home that we love that we know the asset really well. We've known it for 6 years, and there shouldn't be surprises here beyond what we've underwritten for, because we would have found them already. So really substantially de-risked investment from a CapEx and deferred maintenance standpoint, which is really attractive.
Great. Thanks, Josh. Well, thank you all for your questions. Thanks for joining the webinar today. If you didn't get your question answered, or if you do have additional questions, you can go ahead and just post those in the chat, and we'll be happy to follow up with you separately. If you're interested, you can just contact our investor relations team. You can send an email to investorrelations@burgo.com. And thank you so much for joining the webinar today. Hopefully this was helpful and educational, and we would look forward to partnering with you on this project.
Thanks, everyone.